Merhabalar Cüneyt. Michael, thank you so much for coming. I have all your articles right in front of me. I'm very proud of you. These are the articles as I sent to my producer from the Wall Street Journal's online version. And you wrote two articles, one about the stock market, the equity markets, and another one in gold, about gold.
Right.
And those are the two hot topics. Even as of today, we're seeing different movements in terms of gold. But let's start with the stock market. You say, what could kill a stock rally? What could kill a stock rally, Michael?
Well, as you know, I've been bullish really since January of last year, pretty much consistently, as various intermarket trends were suggesting a rally was coming. Now, we are at a point where we could be entering somewhat of an extreme, not in the stock market, but in something that could affect the stock market, which is credit spreads. So if you were to take a look at low-rated debt versus high-rated debt, the difference between the two is actually pretty extreme. Now, that's not necessarily a negative, but if it's a suggestive of too much risk-taking in risky debt, it makes it vulnerable to some kind of weakness, which in turn would then filter to equity. So what could break the stock market, paradoxically, is not the stock market. It's actually the bond market.
S&P 500 is expected to go down about like 10%, or they say because it rallied since March 2009 up 116%, it came to the saturation, and we should be expecting bear markets going forward, especially in 2014. Do you agree with this statement?
I don't think so, because central banks are essentially pumping the world with so much liquidity because they are absolutely paranoid of a 2008 repeat. And, I think this is kind of a very important point. Words matter. We live in a world where confidence is key to economic activity. The clearest example of that is Europe. The ECB, European Central Bank, did nothing last year.
That's right.
All they did was say, we stand ready to preserve the euro, do whatever it takes, and look at the huge move in European markets, and now the recovery that may be starting to take place. So words matter, confidence matters. As long as central banks are there to try to provide confidence in addition to liquidity, that alone probably prevents the fear of a recession. And, we're in a very conservative environment now. A lot of people, a lot of money, a lot of companies haven't really taken too much risk. You tend to see a lot of risk before a recession, not, or rather, right, exactly,
yeah.
or after a recession, rather before it.
Yes,
Right?
yes,
So,
yes.
so I don't think the conditions suggest that. If anything, we could be in this kind of slow and steady economy that nobody really believes, and that we could see the Fed and other central banks pull back on liquidity.
That's what I was going to ask. Fed just recently announced they might have an exit strategy in 2013, either mid or towards the end. That's unclear.
Right.
But what do they mean?
Well, look, the Fed has tried to target unemployment, right, in
Right.
terms of how much they're going to keep stimulating to get that down. Now, because there's some dissension in the ranks within the Federal Reserve as to when to end the bond buying, possibly by the end of this year, based on their last Fed minutes.
Do you think they will succeed this year?
I think if they affect psychology enough, they will. It's one of those things, there's a great quote, what one believes to be true is either true or becomes true, right? Kind of like, je pense donc je suis, I think therefore I am. So if the Fed is basically telling the marketplace, we may cut back on stimulus, what's the market going to do? Start borrowing. Start getting, because if the fear is that those rates are not going to be low forever, then you got to take advantage of them now. If market participants do that en masse, that will cause an economic activity, that will cause unemployment to fall, that will cause them to actually have to reduce the stimulus.
I know it's very recent, but have you seen that kind of participation
Well,
from the market participants?
I think the stock market is anticipating that when you look at the behavior of industrial stocks, which dramatically outperformed, you look at the behavior of financials, which keep on leading, the market is betting that that's going to be the case. And it's also when you look at staffing stocks, when you look at a company like Robert Half in the United
Right.
States, that's handily outperformed the S&P. Why would that be? Because the market is betting that unemployment is going to fall. Why would unemployment fall? Presumably because there's going to be some kind of pickup.
Some kind of pickup. Perfect. I can talk to you about anything, Michael. You're wonderful. Let's talk about the gold, right? Commodities, another market. You're talking about the gold's dilemma in 2030. What kind of dilemma are we facing in terms of the gold's performance?
Well, gold has been a phenomenal performer for the past decade plus. And every investment has to compete for attention from money. Right? Now, if the Fed is going to start to pull back a little bit on QE, then that's probably more beneficial towards stocks relative to gold. So while gold may have outperformed, stocks probably now catch the leadership trade. As you enter a more favorable positive real rate environment, meaning when interest rates are higher than inflation, historically that's a bad environment for gold to perform in. Gold tends to do well when inflation is higher than interest rates. If you start to enter what could be the very early signs of a tightening cycle, very early signs right now, that's not good for gold. It's very good for equities because it means if they're tightening, then obviously activity is picking up.
I see you're again bullish. What's your outlook for S&P 500 for 2013? What do you expect the level to be towards the end of the year?
Well, in terms of the next 3 months first, I do think that we're going to see some kind of winter breakout in the Dow and the S&P making new all-time highs, consistent with small cap averages and mid cap averages.
And in spite of the debt ceiling debate and the fight we're expecting in February?
You know, the market is so resilient. Last year, it went through the supposed end of the euro, the fiscal cliff, and the Mayans also somehow called for the end of the world, and the stock market kept on going up. So I think the debt ceiling debate is going to be a bit of a sideshow given how much the market has already endured. Now, I do think it's going to be a very strong year, but I suspect at some point in the latter half of the year, there could be a more meaningful correction from a more elevated level than where we are now. It's not something to be concerned about just yet, but something to, at the periphery, be attentive to.
And some investors are very guilty, let's say, or sad that they missed this boat, right? Because last year we had that kind of a increase. I want to also talk about the earnings, Michael. We're in the earnings season right now. The expectations were lowered,
Sure.
but Alcoa surprised us. Should we expect to see more surprises? And if yes, why and in which stocks do you expect?
Yeah, no, I think unequivocally you'll see more surprises because there's been this career risk for a lot of analysts in terms of being too aggressive on estimates, right? So rather than risk your job because of all the uncertainty over Europe and the fiscal cliff and all this, then why not just be extra conservative? So you leave more of a gap for a surprise to happen on the earnings side. The areas which are probably most beaten down, which are likely to show surprises, I think, similar to Alcoa, are really the materials stocks. Those have pretty badly underperformed since 2010. And it's been, the commodities trade in general has been one that's been very dependent upon China. Now, if you notice, China's starting to pick up again when nobody really thought it would start to happen. China picks up again, materials, revenues, all that picks up. Those estimates are going to have to be revised going forward, continued earnings beats probably as a result.
So you expect the demand from China to increase, like
at the margin,
Alcoa,
right?
At the margin, they are talking about an 11% increase. But Alcoa usually surprises us, but in a negative way. This was a nice surprise. They're talking about a 2.9% growth in earnings compared to last year.
Sure.
For the S&P 500 companies. Is this rational? What is your number?
Well, I mean, as far as earnings, it's never really known until it's hindsight.
Until the time.
But I think this is kind of an important point, which is that market advances can affect earnings rather than earnings affecting the market. Because as the market advances through the wealth effect, through the idea that people feel more confident, start to spend, companies begin to enact various expansion plans, because the market itself is rising, earnings then and activity pick up. Right? So if the market were to continue along this pace, earnings will probably increase to catch up to the market.
I want to talk about your fund and your clients, because yours is a success story, and it can tell us about what the participants or what the feel is in the market. Can you tell us about, how did you perform looking back 2012?
Last year for us and for our clients, for our ATAX strategies used in our mutual fund and separate accounts, was a very good year. We call ourselves the inflation rotation manager.
Inflation rotation.
And the idea really is that conditions matter more than predictions, right? So you have to kind of identify the conditions.
I like you to say it slowly. Conditions
matter more than predictions. And so I'll give you an example. If you're going to take a drive from here, New York, to someplace an hour from now, that's 50 miles out, okay, that's a good prediction. But if it's raining, that prediction is kind of meaningless, right?
That's right.
So you have to consider
Depends
the environment.
on the conditions.
Right. So the conditions that matter most for risk taking are inflation expectations. If the market thinks inflation's coming, risk on equities. If the market thinks inflation's falling, risk off bonds. Now last year, our models dictated that during the April to May period and October period, inflation expectations were falling. That's when the two mini corrections occurred, we rotated into bonds, avoiding the equity drop. And mathematically, when you avoid declines, you actually have a much better shot of outperforming. So we did quite well in terms of the separate accounts. And the mutual fund, although it's new, started mid-September of last year, is already in the top 1% of its category in Morningstar, based on the same algorithms and based on this idea that focus on inflation expectations and the conditions that nudge risk-taking first, then figure out how to execute.
You talk about inflation expectations in your algorithm, but how do you gauge it? How do you put it inside your algorithm? What is your data?
Well, that's partially the secret sauce, but kind of
you cannot give it out.
but as a kind of intellectual point, the market itself, through various intermarket trends, all these price ratios I focus on, tells you something about what the market thinks. So I'll give you an example. Let's say home builders, the stocks, are outperforming, meaning they're going up more or down less. So home builders are going up 1%, the S&P is going up half, right? So it beats by 0.5%. If you see that trend continue and home builders are outperforming in a way like this, that tells you the market is anticipating inflation, or at least anticipating growth, right? So the market is betting on it through price action. So while we don't necessarily use that particular relationship, the idea is to look within the market to see if these relationships are telling you something about the either conscious or unconscious efforts of the market in terms of preparing for future inflation. That inflation may be wrong, right? It's about expectations. Expectations set price, not economic data.
Inflation is the key, right? Yesterday, I think, 2 Fed members spoke. One of them said they both kind of criticized Fed's exit strategy or how they would get out. One of them criticized the 0%, close to 0% interest rate policy. The other one, the bond buying and the exit. Even though they helped us, they say that in the long term, especially the 0% interest might hurt the financial stability, the increase in the financial stability, and also the inflation, because they are tied to numerical data as opposed to economic calendar. Well, then they say that inflation, as opposed to, as long as it is under 2.5% and unemployment 6.5, this is going to stay. Do you think they will have to change this statement? They will go back to the roots?
It seems like almost every month they're changing their
Every
statements.
month.
But I do think that there's an evolution happening with the Fed, which is maybe they're moving more towards this nominal GDP targeting. In other words, rather than target unemployment, rather than target inflation, they target inflation plus growth and target that kind of a rate. So that, let's say the nominal GDP target is 4%. Okay, well, if GDP growth is 1, they're going to want to get a 3% inflation rate.
But they didn't tie it to the GDP growth. They didn't mention.
But I think they're on the pathway to that. I think these are kind of the early signs.
So this is what we should expect from Fed to add, maybe you're saying.
It seems that's the evolution of where we're headed.
And what do you think about Jack Lew? And that's my last question. The new name for the head of Treasury.
From what I've seen, he seems to be among the sort of inner circle on Obama's team. I'm not a huge fan of too many people agreeing with the same thoughts, right? So I think you need to kind of break groupthink. You need to break the complacency in one single idea. I don't think Lew seems to be the type of individual who would necessarily bring in different ideas or challenge the administration in a way that would be beneficial to the U.S. economy long term.
Well put. Thank you, Michael.
Thank you.
And here, our interview is ended, but we need you back again.